I'm Krista Freeland with Reuters, and I'm delighted that today I and a group of my fantastic colleagues will be interrogating Gary Gensler. He is the chairman of the CFTC and a man at the center of many of the most heated political and economic debates in America and the world today. So thank you very much for joining us, Gary.
Krista, it's terrific to be with you. That's a kind introduction at the commodity.
I can say worse if you want.
Yeah, I know. But at the Commodity Futures Trading Commission, we swim in the lane of derivatives. We've overseen the futures market since the 1930s, and as you listeners know, that with Dodd-Frank, we'll also, along with the SEC, be overseeing the swaps marketplace. And I think at the core, what Congress wanted to do is to bring transparency and openness and competition to that marketplace. Congress has been very specific as to how to do that, and to use central clearing and to regulate the dealers as well. Now, where we are as the CFTC is we identified about 30 topic areas to do the rule making. And in 28 of those topic areas, we've made proposals. So we're rounding out near the end of the proposal phase, and what we need most from the public, from everybody listening, is their comments on these proposals. They're just that, they're proposals. There's a mosaic now out there, and we have a bit of a pause at this point in time where we can reflect and get the comments. We've already received over 4,000 public comments, but I suspect and hope that we'll get many more about the rules, about the costs and benefits of the rules, how they comport with what Dodd-Frank passed, and ultimately, before we move on to final rules, that we can summarize them, take them on into consideration, and think best how to comply with Dodd-Frank. One of the questions we ask the public is also on phasing the implementation. Congress gives us great latitude on how to implement this over time. We might finalize many of these rules this summer. We're human. Some will be past the July 15th date because we want to get these right and take them all into consideration. And the only other thing I would say is we're a small agency with funding of about $168 million, about 670 or so people. We have about the staff that we had in the 1990s. We're far smaller than the industry we regulate. Congress passed broad reform to cover a $300 trillion marketplace, about 7 times and more complex than what we currently cover. Naturally, you would think we'd need some more funding, and the President put forth the budget for 2012, next year's budget, which would call for about $300 million of funding, which would include about a doubling of our technology and about 45% more staff. We have no grant money, we just have staff and technology. So with that, I'd be happy to take questions.
So let's pick up on the funding issue you touched on. There's a fight going on about it right now. Is there a danger that these broad authorities, these broad new powers that the government wants the CFTC to take over, it's just not going to happen because you're not going to have the people or the technology to do it? And is that maybe the intention of some of the Republican opponents of more funding?
Well, I think that we'll move forward along with the Securities and Exchange Commission and be able to finalize the rules over the course of the spring and summer months. But to actually implement them, to actually oversee the markets, we do need additional funding. We anticipate there may be 300 or 400 new registrants, swap dealers, swap execution facilities, data repositories, and the like. We need to process those applications and give legitimate feedback to people. So, though we can finish the rules, it is quite clear to us that we can't really fulfill the mission in the futures or swaps market without sufficient resources for both staff and technology.
So the political discourse in America right now is very much about government becoming more efficient, cutting government budgets. Maybe we should be trying to do that?
Well, we are. We're a very efficient agency. I mean, when you think of only 675 people and you think of the breadth of this industry, $300 trillion notional amount of swaps, $40 trillion of futures, 12 million contracts traded a day in the futures market. I think this is a great investment for the American public. And as the President put forward for 2011 and 2012, that we should increase our technology budget, but there's also staff that we need, but technology more significantly than staff. So that's efficiency. I dare say that very few of the listeners on this right now spend less than we do on technology. Our agency only spends $31 million a year last year, and unfortunately, under the continuing resolution, we have to cut that this year.
So there has been a big change in the market quite recently with the merger, proposed merger of Deutsche Börse and then the stock exchange. What's your view of that?
We're an agency that is there to ensure that markets are free of fraud, manipulation, that the market integrity, and that they're transparent. So we don't have a specific role as long as those companies that are registered with us as exchanges, what we call designated contract markets, or the newly formed swap execution facilities and clearinghouses, fulfill all of their obligations under our core principles.
The deal, though, has already had some impact in the political discussion around what you're doing. You know, there have been comments from people at the CME about how this is a sign of the danger that regulation is too tight and continuing. There'll be offshoring.
Did somebody say that about me?
Yeah, they do say. There'll be some of this, really lucrative business will move outside the United States. Aren't you worried?
I believe that markets work best when they're transparent, when they're open, when they're competitive, and that economists show that that narrows spreads, and end users and investors get the benefit. And I also know that we're working very closely with European and Asian regulators to have consistency with regard to the regulation of the derivatives marketplace. But let us not forget, derivatives were part of the 2008 crisis, and the system failed, and the regulatory system failed. So Congress reacted and said we need to bring the oversight of the securities and futures markets also to this vast market that had been unregulated.
So you're right about 2008, obviously, and part of what happened was an international race to the bottom. You'll remember the big debates about whether New York was losing its financial supremacy to the fantastic light touch London regulation. Isn't that happening all over again?
Well, I don't see it that way. I see that we had a crisis. The regulatory system failed. The American public bailed out many financial institutions that were either lightly regulated or not regulated, or in some cases poorly regulated. And Congress reacted. And I think it was historic what Congress did to bring transparency to these markets and to bring them into central clearing, which helps lower risk. And so that's what we're doing. We're complying with what Congress did. And the Europeans have a very similar approach that they're taking up in the European Parliament actually this month and into the spring.
Is this taking too much time? You referred to the 2008 failure. That's a long time ago now. Isn't there a danger that these problems are building up? You talked about the mosaic consultation. That sounds great, but markets are still there.
Well, I think Congress set 1 year for us to do rules in part because they were very mindful this was a very real crisis and they wanted to lower regulatory uncertainty. So we've moved forward, and through the course of 12 public meetings and nearly 600 meetings with industry, and we list them all on our websites, we've put forward the proposed rules. We now need to hear from the public, and we need to consider those public comments and move to final rules along with the SEC over the spring and summer months. But I agree with you. It's important that we bring the reform that Congress mandated.
If you could, would you move the process faster?
Well, I'm so proud of the people at the CFTC. I mean, it's a small agency. Nearly a quarter of the staff are working on one of these rule teams. There's 31 teams now. And it's an excellent team. So they're moving forward. The commissioners, Mike Dunn and Scott O'Malley and Jill Summers and Bart Chilton, are just fully engaged. But I think this also takes some time to hear from the public, and in many cases, consider their comments and get the balance as Congress wanted us to.
I'm now going to thank you very much, Chairman Gensler. That was terrific. And I'm now going to turn you over to a very robust question from my
You earlier
colleagues.
called it interrogation.
It will. Okay, it can be an interrogation if you like.
No.
Mr. Lester?
Sure. Mr. Chairman, do you think it was that Congress has maybe unfairly pulled the rug out from the CFTC? I mean, they give you this daunting agenda for Dodd-Frank, and at the same, they give you a year to implement it, and now they, trimmed the budget proposal that was initially asked for last year, kind of leaving you hung out to dry in what arguably is a very important time for the agency and Wall Street that is following what rules are coming out from your agency.
Well, we're going to continue to work with Congress with regard to the funding. Our agency is only this year back to the size we were in the 1990s. And with the help of Congress, we were able to get back to it. 2008, we had shrunk over 25% from the 1990s. So we're going to continue to work. The President has been enormously supportive and he's proposed for 2011, the year we're in, that we have significant increases to that funding. There's no doubt, though, that if we were taken back to the 2008 levels, which was only $112 million compared to the 168 or so million that we were funded out last year, if we were taken back to that level, we could not fulfill our mission. We could not pursue all of the enforcement actions and even oversee the futures marketplace, let alone the swaps marketplace. That we've estimated that in this order of about 700 people is what we need to oversee the futures marketplace, and then increase, as the President has recommended for 2012, about 300 people for swaps marketplace, and the technology, as I say, about double.
So do you think Congress has pulled the rug out in terms of leaving you in this position? You giving you that agenda?
Well, we're going to continue to work with Congress. The law is not implemented yet. We have the staffing to work on the rules, work on them closely with the international community and with the other American regulators. But we do need additional resources. There is no doubt. We oversee an industry that is measured in the trillions of dollars. With the swaps market added in, it would be about $340 trillion notional amount between futures and swaps. With about 670 people, that's a $500 billion a person. I mean, it's just arithmetic, but the reality is that Congress gave us a big role along with the SEC, and we'll continue to work with Congress on sufficient funding.
Just to quickly follow up on Chris's question, don't you think there could be a political agenda here? It's now a Republican Congress. The Starve the Beast strategy is a long-standing Republican one. Not everyone is in favor of more aggressive approach to regulation. Maybe this is a backdoor way to hobble you.
I can only speak for the agency and its needs, and we're going to continue to work with Congress. We've had very constructive dialogue in both the House and the Senate with Republicans as well as Democrats. I think that people on the Hill, the staff as well, understand that we have a large mandate along with the SEC that has been unmet. And there's been a debate. Congress settled upon a law, and the President signed it last July, and that it's important to fund the agency. So there is an effective cop on the beat. And beyond that, that the marketplace, whether it's the large swap dealer or the newly formed execution facility, has somebody who can answer the phone and answer their questions and actually use technology to ensure that the markets are free of fraud and manipulation.
Can I perhaps come back to something that you said earlier, sir, about the issue of international cooperation? You said you were working very closely with the Europeans and the Asians to get some consistency in the derivatives area in particular. It's my impression, looking at it from the outside, that actually you're far ahead of the Europeans in terms of particular derivatives regulation, and Asia is somewhere way off there. Do you share that, and if so, how concerned are you about regulatory arbitrage?
Well, in fact, Japan moved first. Japan passed their law a couple of months before the U.S.
Right.
We're working very closely with the Europeans, the European Commission, the European Parliament, the FSA in London, Paris, across the continent, and very encouraged that in terms of what the European Parliament is taking up as we speak, it covers clearing in a very similar way to what we have here in this country, and data repositories and the dealer regimes. They have a separate consultation called the MiFID review on the trading and the reporting. So though we have different cultures, we have different political systems, there will be some differences. There's been a great coordination. And I would note, even in our rule writing, we've shared many of our draft documents starting last September. Our internal memos at the CFTC, we shipped them over to the European Central Bank, the European Commission, the various agencies, and some to Tokyo and to Canada, to get their feedback as we move forward with the rule writing as well.
So no loopholes?
Well, I don't know. I mean, what you're defining as, I mean, we do have different political systems and different cultures. There inevitably will be some differences. But I'll take one issue with regard to the clearing was about end users, commercial end users. We've collaborated on this issue for a year and a half, and very similarly, the financial companies and swap dealers mandated by Congress needed to use clearinghouses for something called a standard contract. And the non-financial, the commercial end users had a choice. Very similarly, for instance, Europe is taking that up. There's a great deal of consistency. But you're right, they are still taking it up.
All right. Okay. Can you perhaps describe to us a little bit your relationship with Wall Street? You described this big, multi-trillion-dollar behemoth that you are trying to regulate in a fairly aggressive way. What is your relationship with some of the CEOs? How do they? What kind of conversations do you have with them? Don't disclose everything, of course, but give us a flavor for that.
Well, actually, we list all of those meetings on our website, so, and even if they're
Give us
phone calls, they're listed. I think they've been very constructive in giving us comments on these proposals before the proposals and after the proposals are met. They don't always agree with each other. They don't necessarily agree with asset managers and hedge funds and what you might call the buy side or end users. So there's hundreds of comments that come in. One example recently, we had 29 comments on a question about segregation in the clearinghouses. And they run the gamut, these 28 or 29 comments, letters, are very different. So mostly these large organizations engage with the CFTC through their staffs. They have sometimes dozens, if not hundreds of people working on it. The chief executive officers don't ask for meetings often, and so I don't have much one-on-ones. In fact, they're usually in a group meeting. The Financial Services Forum puts together one of these industry associations.
Chairman, with the recent run-up in commodity prices, specifically oil, do you expect to get any additional pressure from Congress and others in the public, to do more to clamp down on regulation, to tighten regulation?
Well, I think, and it goes a little bit to the earlier question, markets work best when they're transparent. They work best for the investors and end users. And I think that one of the great innovations of our society over time were the innovations in the 1930s, when the Securities and Exchange Commission was set up, when our predecessor, the Commodities Exchange Authority, was set up. Those are similar to what's happening now. and they are as relevant to the energy markets as they are to the overall markets. And it goes to your question about Wall Street. I think markets work best when they're transparent and they're rules of the road. In terms of the energy markets, there's also something particular that we've put forward with regard to position limits. As you may be familiar, we've had that authority since the 1930s. Working with exchanges, we have used that for the agricultural markets, the metals markets, the energy markets. In the early part of the last decade, in 2001, the exchanges sort of discontinued certain position limits in the energy markets. And so we re-proposed those about a year ago. We got 8,000 comments on those. And Dodd-Frank, Congress said, extend those to the swaps marketplace as well. So we've put out a proposal in January. Based on the 8,000 comments, we changed it, and we look forward to comments now to see how we move forward.
I've been reading the comment letters as they've been coming in on that specifically, and there's
Good for you.
A lot of consumers.
You know, there's 2,800 comments on position limits already.
Yeah, I do.
Yeah.
They pop onto my screen every day.
All right.
And there's a lot of consumers drawing, making the connection between oil being over $100 a barrel and the presence of speculators in these markets. And the CFTC data shows sort of record levels of long speculation last week. Are you willing to connect those dots and saying if we had position limits, there would be an impact on prices?
The CFTC is not an agency tasked with setting prices. That our mission, since its beginning, is to ensure that markets have integrity, that they're free of fraud, manipulation, they're transparent. That buyers and sellers come together and they have some transparency before the transactions and after. That's why in the 1930s, Congress mandated that all futures had to be on exchanges. That's why this past year Congress mandated that standardized swaps had to come to clearinghouses and have some transparency. But we don't set prices. I think that position limits help in a marketplace to ensure that they are not too concentrated. And that's how the agency has taken that authority in the past in the agricultural space and so forth. We also have, working with the exchanges, set position limits to ensure against corners and squeezes because these are products of finite supply.
So does the fact that people, though, make that connection between position limits, lower energy prices, does that make your job trying to make these markets more transparent? What you just laid out, harder or easier?
Well, there are a lot of things that make the job interesting, and I'm so honored to have the job. But I would say with regard to position limits, we have a rule outstanding. We look forward to the public comment on it. Though we're not a price-setting agency, we are about ensuring that markets have integrity and making sure that buyers and sellers meet in that marketplace and they're not so concentrated that there might be corners or squeezes, or so concentrated that in rainy times or good times that there are distortions. What Congress says is burdens from excessive speculation.
So
and if I can say one more
that
thing, can I say one more thing? Hedgers meet speculators in the marketplace. And so if you're an agricultural producer, you're a farmer producing wheat or corn, and you want to hedge the price at harvest, there's somebody on the other side, and that person on the other side may not have corn or wheat. They're a speculator. That's a natural part of markets. It's not a bad word, so to speak.
No.
Hedgers meet speculators. What Congress really has said is they granted an authority and said we shall use it in the 1930s. They revised that last year and again said that we shall use it with regard to ensuring that they're not burdens from excessive speculation. So we put a proposed rule out. We look forward to the public comment, the comments on the cost, the benefits, the economics, the policy, the legal interpretation, comments on it all, and we'll sort through that hopefully this summer.
How have the markets been performing this recent run-up then in oil?
Do you have a point of view? Did you?
No, I'm just asking you. I mean, you've gone through, you've laid out pretty much what your role is as a regulator. So take that to the recent run-up in oil. How have they been performing?
Well, I would say this. I'd say in the swaps marketplace, we don't yet have the transparency because the laws haven't come into being. I think the markets will work better when we have that transparency to the regulators and to the public, which we don't yet have. I think that the markets will be less risky when more of these transactions come into clearinghouses. We are fortunate there is a lot of voluntary clearing in the energy swaps market, but we're not there yet. The dealers are not regulated yet. The clearinghouses, though operating and in many cases having a lot of volume, aren't what Congress yet passed. So Dodd-Frank is not yet in place, and I think it's a very important piece of overseeing markets in energy as well as others.
And as a regulator, what runs through your mind when you start seeing something like Libya going on and oil prices, going crazy?
Well, mostly what I do on a day like that.
Personally, yeah.
Yeah, no, is I ask the surveillance staff. We have excellent surveillance staff. There are not many of them. It's a small agency, but I ask them to come up and do a briefing. We for over 30 years have had this Friday.
But do you sit there and freak out, or what happens in your office?
No, that happens when my daughters tell me something. But I asked for a briefing. As I remember last week, I had a briefing, and then we also did it as a full Friday. Every Friday for the last 30 years, we have the Commission closed-door surveillance briefing. And those briefings involve confidential data about which traders are at which places. Again, in the futures marketplace, we don't have the swaps data yet. And I ask questions about whether there's any concentrations and whether the surveillance staff is seeing any manipulation or trade practice violations, and get into a dialogue about what the exchanges are seeing in our conversations with the exchanges or other regulators. So we have the benefit of good relationships with the exchanges, and with the largest regulated market is over in London with the FSA as well.
We had Barney Frank in here just a little bit ago this morning.
Great.
And yeah, he was great. And he was especially he was speaking about the intent of Dodd-Frank, and we asked him, what is there anything happening that maybe is going beyond the intent of Dodd-Frank, or is not really living up to the spirit of it? And he brought up on his own CFTC and position limits. And he said that it was an open question, but he's feeling more confidence now that there is a resolution, that you will be able to move forward with the position limits. How are you getting that buy-in, even with having internal disagreement with CFTC? How are you getting that buy-in internally and from the markets to do position limits?
A lot of consultation, a lot of discussions with market participants, and with commissioners. There are 5 independently confirmed by the Senate commissioners. The commission process is a very constructive one. If we meet 3 or more in a room, we have to do it under the Government Sunshine Act with all of you in the room too. So it's usually one-on-one. And sometimes I move from a meeting with Mike Dunn to a meeting with Scott O'Malley or to Jill or Bart. We just and they meet, but there's a lot of consultation. The staff is doing a terrific job as well.
And with those consultations, are you getting traction? Are you getting
Well, we put out a proposed rule in January, and we're looking for public comment on it. So we have a proposal in front of the public. It was different than the proposal we had put out a year earlier. We benefited from the 8,000 public comments. We addressed things like called crowding out. I know it's not an issue for this interview, but we addressed numerous issues the public had raised. I suspect, since we already have 2,800 comments on our comment file on position limits, that we'll have yet numerous comments on this. And some will be on one end of the spectrum, some will be on the other end of the spectrum. They'll be technical, there'll be some of them economic. They'll be enormously helpful.
Commissioner Dunn has said that he wants to see some economic evidence, if it's available, that there is either the excessive speculation that I talked about earlier in these markets, or that position limits would prevent that. Are you doing anything to answer those questions that he has raised publicly?
Well, part of his question is to the public to send in information. So we're still in the comment period, so I think we have to wait to see what the public says on that. But as our general counsel has said in live hearings to this question, position limits, as they have been done for decades in the agricultural and metals and energy markets, are also proscriptive, meaning looking forward in terms of how the agency has looked at it for decades is to ensure that the markets are not so concentrated, whether for corners, squeezes, or the burdens that might come from excess speculation.
Okay, so Commissioner Dunn has heard your general
I have to
counsel.
hit a off button or something. See, this is how I do things. That was Bart Chilton. That's on my
Oh, he's welcome to join us.
You know, but that's how we do
Did
things.
you send it?
No, the phone was ringing.
It's not a texter.
It doesn't say, please tell Reuters. I'm watching and good job.
So Commissioner Dunn has heard your general counsel, Dan Berkowitz, talk about that at length. But still, he's saying that he believes that kind of economic evidence should be laid out. So other than public comments, are you doing anything to sort of make that argument or to make that economic case?
As I will repeat, we're going to hear from the public. The staff continues to work. We have 31 role teams. Each one of these staffs, we have a no chaperone policy too. Each of the staffs can meet with the public, can meet and are encouraged to meet with other regulators and commissioners and get feedback as they see fit. They also have permission to deny meetings too. They have to get their work done. But it's been I'm so proud of the agency. It's been a very open process. Yesterday we had a technology advisory committee meeting, and one gentleman was presenting the cost of putting forward some of Dodd-Frank. And it was very helpful, but in the midst of that, I said, now I want to make sure this entire record of this meeting is in our comment file. One of the things he said was that the financial industry, this was from the TAP group, Larry, I can't think of Larry's last name. TAP, Larry TAP. And these documents are on our website, but that the financial industry spends between 20 and 25 billion, that's billion, dollars a year on technology per year. We spent $31 million last year. Now, he did say that they would have cost, and we were very interested in the cost. He thought over 3 years it would be the cost that he laid out in his documents that you can look at. So we're learning in every one of these meetings, and we have a natural pause right now. We're not taking out final rules in March. We're going to try to do a meeting late in March. We have a number of topics still outstanding. I did say we've covered 28 of the teams. We did make a 31st team. It's the conforming rule team or the cleanup team, whatever. But it's looking through all of our existing rules to do the conforming amendments or cleanup amendments. But we have a number of topics left outstanding. We're probably not even going to finish that in late March because they rely on other agencies, and there's capital and margin that we're working with the banking regulators and the SEC and so forth. All of our teams are coming forward with their summaries of the comments. Many of the comment periods just closed, some are still open. We're going to review those comments, get advice from all 5 of the commissioners, get advice and counsel from other agencies. So I think we're in this natural pause, and we'll start to take up proposed final rules from the staff. They're still proposed then. The staff will be coming to us with some proposed final rules in the spring. The commissioners will weigh in. We'll do the consultation as we talked about earlier, the one-on-one consultations, the phone calls. And we'll try to take up some of the final rules, as I say, in the spring and into the summer.
Do you think there are some swaps that are less risky than others?
To whom?
To the market? I mean, for example, FX swaps compared to credit default swaps.
I think that the market benefits whether it's a 1-year swap or a 30-year swap from transparency, but it is true that a 30-year swap by any economic survey has more volatility, and thus this word risk can mean a lot of different things, so I'm being careful, but the longer the duration of the swap compared to a shorter duration, has different risks. So I would have to say yes to your question. But I think the market benefits from transparency and competition, whether it's a 1-year swap or a 30-year swap.
What's your position on EFS, since that seems like a very untransparent?
You're going to have to help me more with your question.
An exchange for swaps?
No, but which, I mean...
Just wondering in terms of transparency, is that seems an obvious example of an untransparent transaction that sounds like it goes against what you seem like it should be.
Where a buyer and a seller meets and does a transaction, and markets benefit to understand that price. It's part of what's called the price discovery function. And the more openness you have in that price discovery function, the better. There are some transactions that aren't necessarily between a buyer and a seller. And the nature of your question leads me to believe you might be talking about something where somebody just exchanges a future into a swap, or changes a swap into a future, but it's really one party exchanging that. But I'm not entirely sure I follow your question. But if it's between a buyer and a seller, if it's really part of a marketplace, the market benefits to having that price discovery function happen in a central place. The futures marketplace is that and performs that function very well. The swaps marketplace is yet to do that in a central way where there's a price discovery market and there's competition. I think Congress recognized that, and that's why they mandated that there be swap execution facilities, at least for those swaps that are cleared and made available for trading.
Chairman, are you talking to Treasury at all about potential exemption for Forex swaps?
Yes.
What kind of advice are you giving them?
I think that they know my advice.
Can you give us your personal opinion on whether these swaps should be exempt?
Well, the statute that Congress passed said that interest rate swaps, currency swaps, commodity swaps, equity and credit default swaps be regulated by the Securities and Exchange Commission and the CFTC, and there would be a new regime of transparency and clearing. It did reserve for the Secretary of the Treasury to make a determination of one category called foreign exchange swaps and forwards, whether they be in. And I know that the Treasury Department is taking that up, but you'd have to ask them about their timing and how they're moving.
But do you think they should be cleared, the FX swaps?
I think that my record on it, and you can probably look to an August 2009 letter on that, but Congress debated it, and Congress left that decision to the Secretary of Treasury.
Mr. Chairman, you recently hired a new director of enforcement. What do you...
Good guy.
Do you anticipate the CFTC being a tougher cop on the beat, conducting more enforcement cases, and what areas specifically do you anticipate targeting?
Well, enormously grateful. David Meister has a really accomplished career. He served in the Southern District of New York. He served in the private sector, and he was willing to join us after Steve Obey had decided to move back to New York. Steve's family had never moved down, so when I came on board, our acting head of enforcement, Steve Obey, was commuting every weekend and so forth. Dodd-Frank Act actually broadens the scope to swaps. So I would envision that as the law becomes effective, that our enforcement staff would broaden from the review of just the futures market, now also to the swaps marketplace. The Dodd-Frank Act also gave us new tools, and those tools with regard to disruptive trading practices, those tools with regard to anti-manipulation, Senator Cantwell and Senator Lincoln worked very closely on a provision with regard to manipulation, and we've put out a proposed rule on that as well. So we have a broadening of scope, and we also have some new authorities that Congress gave in disruptive practices and anti-manipulation.
So Americans also have a sense that the largest banks dominate the derivatives market. They have the wealth, they have the power, and it becomes too big to fail. What are we doing to address that?
Well, it is a perverse outcome of the 2008 crisis that many of the people in the public and in the markets feel what you just said. We at the CFTC just swim in the derivatives lane. And I think that in terms of derivatives, the best that we can do is to ensure that as many swaps as possible come into clearinghouses. Clearinghouses stand between two parties in case one of them defaults. They back the transaction in case somebody fails. So what that means to the American public, it's less likely that the taxpayers stand behind that transaction. Instead, the clearinghouse stands behind it. And I think that that's what Congress recognized, and moving as much of this into clearinghouses lowers interconnectedness, but also says a clearinghouse stands there, not the taxpayers. I also think transparency helps. Let us not forget, in 2008, part of the crisis was something called toxic assets. What were these derivatives worth on AIG's books? What were they worth on other people's books? The law now says they have to be valued daily, and the valuations have to be shared between the counterparties. And if they're on a clearinghouse, the clearinghouse has to share it with the public. So in the lane we swim in, it's transparency, it's clearinghouses, it's, of course, the regulation of the dealers, and some of it's kind of the boring back office stuff around business conduct, that the transactions have to be even documented, lowers risk.
But in this lane, too, is that you have these Wall Street banks that have this grip on this amazing profit center for them and have successfully elbowed out regional banks and others that have wanted to get into it. Is that, how close are we to opening it up and loosening that grip?
Well, I think Congress's intent was to open it up. We'll see how successful. You'll get to judge that in a few years, I imagine. But let me mention three areas that Congress addressed and we've put in the rules. One is that the execution platforms have impartial access. So our rule on swap execution facilities says any market participant can leave a bid or an offer. A small regional bank, if they want to make a market in 2-year interest rate swaps, can. And everybody gets to see it. Secondly, they said that the clearinghouses have to have open access. The futures marketplace largely does have that. The swaps marketplace has not. They've had very high limits before somebody can become a member of a clearinghouse. We proposed rules in December to address that and say you cannot be excluded. You might be able to be scaled. You're smaller, maybe you can't be as big a member, but you have to be let in rather than excluded. And thirdly, Congress said that the trading venues have to have access to clearinghouses. I think Congress was concerned about competition amongst trading platforms, and they promoted that competition. So those three areas of access, access to making markets, access to the clearinghouses, access for the trading platforms, we've embedded in the rules. We'll see the public comment. I think transparency itself also leads to access.
And do you think, I mean, so you think it'll be a few years before there is that wealth distribution, that profit distribution for the derivatives market?
I don't, you know, I think that you'll judge me faster than that, and you'll judge the CFTC faster. But what Congress said is that this has to be an open, they use the word open access in the statute, or impartial access, or non-discriminatory access. There are three key provisions. They use the word transparency in the statute, and it's for a reason. It's markets work best when it's competition. The tens of thousands of end users benefit if there's competition. That might shift some of the concentration in this marketplace. It may. but markets work better when they're not as closed. And so what I was saying is that you get to judge the CFTC fast or late, but to your question, it might take some time to see whether Congress has been successful in the mandate to bring greater competition.
How about you are, I mean, you're talking about your lane, but you are a member of the Financial Stability Oversight Council, which gives you...
You noticed.
Yeah, I did. Seen the meetings. It gives you a vote on, important issue, broad issue. Chairman Bear has talked about when you go about which non-banks should have more supervision. He thinks it might be a good idea to go through, pick a few firms quickly, and then do some more in-depth study of who else this would apply to. So where do you stand? Do you think that's a good idea, or how should the council go about deciding if hedge funds, insurance companies, et cetera, should be?
I'm honored to be a member of the council. As you probably know, if you studied the council, we've had a series of public meetings, and one of the things that we've done is publish a proposed rule on exactly the question you raised. How should the council determine which institutions are large enough to be systemically important for non-financial institutions? I think that's, so I look forward to seeing what the public says. It's just a proposal. It's exactly the question you raise, is how should the council go about determining which entities are, quote, systemically important. So I look forward to the comments.
How about this idea of maybe, it's taking a first strike of a couple or a few firms that might be fairly obvious, very large insurance companies, et cetera. What about that approach of taking sort of a first strike to show that the council is going to actually...
I think our first job is getting a final rule in place so that the public knows how the council will do it. I don't know if commenters have suggested exactly what you've suggested, but that could be one of the things they've suggested and that we would consider in the final rule. But I think the first stage is just finishing the rule. And then based on that rule, I'm not trying to duck, it's just based on that rule, then the Secretary of Treasury, acting as chair of the council, will probably bring forth the staff. I also want to compliment Treasury's done a terrific job organizing. This is new. It's very different than what existed before the President's Working Group. It's new because there's a statutory framework. So our staffs meet on a pretty regular basis. There's something called a deputies meeting every 2 weeks that we've each of the agency heads identified a deputy. And there are many other meetings in between those deputy meetings about systemic risk, about the rule writing, about something called financial market utilities and so forth. And Treasury has been coordinating this, and it's been it's a very productive stage, but of course it's still a stage where it's being stood up.
I wanted to ask you about what we're seeing as this global trend of exchange consolidation.
Back to Krista's question.
Well, yes, but I'm actually wonder, we had Jeff Strickers talking to us yesterday, who said he thinks it's just being driven by the fragmentation in the equities markets. It has nothing to do with derivatives world, essentially. And wondered if, how you viewed it. Is this a phenomenon that's really, driven by and is sort of, going to be confined to stock securities markets, or does it have an impact on, the derivative side and the OTC swap side, since that is now under your purview?
The lens I view it through is ensuring that our mission is still fulfilled and that any registrant, somebody who's in front of us, can access the markets, which are called registered entities, but can access these markets in the same way, regardless of the ownership structure. So our role as an agency is to ensure that each of these registered entities, a clearinghouse, what's called a designated contract market, fulfills all the core principles of the statute, fulfills the rule book as it exists, that it's an open and competitive marketplace. That's the prism that we are mandated by Congress to look at it. That's the prism that we'll continue to look at it.
But you, as a living, breathing person who knows a lot about these markets,
Oh,
I wonder how
that
you,
part of it.
I wonder how you deal with it. Is it a sort of something that's just one step removed and really is driven by fragmentation and a totally different kind of world for securities? I mean, how do you see it? Sort of, I mean, your analysis is obviously well informed.
It may well be, but I'm also the chairman of a regulatory agency, so I'm most informed by our statute that dictates what we do as a commission, how we address these questions. And your question is a good question, but it's not embedded in our statute.
Don't care to answer it. I mean,
well, because we may have a role. If any entity came in and is changing their legal structure in a way, or their set of rules in a way that we have to review, then we review it as a commission. And there are times that some exchanges come in and say we need to change our legal form, or we're going to change our rule books to accomplish this merger, and we do take that up. But we still take it up under a set of provisions laid out for decades, and those provisions are basically about ensuring that that exchange is still complying with all the core principles, the transparency, the competitiveness, the surveillance, the self-regulatory functions. I mean, it's through all of those prisms. We're going to try to continue to stick with that approach unless Congress changes it.
Some Americans have expressed some fear that some of the regulators, like yourself, come from a Wall Street background, and that could really impact the managing of financial reform. How do you square your background with your current role?
I was blessed to have a really good education at public schools, made it through college, and found myself in the first job, full-time job in my life on Wall Street. And 18 years with numerous professionals, great professional challenges, and yes, high pay. It was a wonderful career. I was then blessed that Secretary Bob Rubin asked if I might serve at the Treasury Department. Basically, he was asking whether he could recommend me to President Clinton, because it was President Clinton that nominated me, and I was blessed to serve then. And I was honored once again that President Obama asked me to do this role. I think that the role of a regulator is to comply with the whole rule book and statute and to fulfill the public mission, which is different than when I was on Wall Street, which is about serving clients, of course, creating revenue and profits as well. And often those can overlap, but sometimes they're different. And so I think that in the role that I have now, I draw upon that experience, but I did leave 13 years ago. You could have been born and bar mitzvahed in that time. And so there are changes, and that's why the meetings we have, whether they be at the chief executive officer or at the staff level, the meetings we have with end users, the meetings we have with exchanges and clearing houses, investor advocates, I think I never leave a meeting without learning something.
But do you think, I mean, the point that Karen was getting at, this notion of cognitive capture, as Will Boyer has talked about, that maybe one of the causes of the 2008 crisis was that too many of the policymakers, maybe too many of the economists, maybe too many of the journalists were thinking from the point of view of the market participants, rather maybe than from the point of view of the system as a whole. Don't you think that's an issue? And don't you think this revolving door, which you just referred to within your own agency, people going from private to public, is maybe a problem with Washington? Not all countries work this way.
Well, I think that the 2008 crisis shows that the financial system failed and the regulatory system failed. And but I think it's probably for a lot of reasons beyond that which it's Carrie raised. I would hope that my personal experience brings some knowledge. It's a little dated. It's a little dated, but I hope that it brings some knowledge and experience. When I was at Wall Street, I was not only on the banking side, but I moved to the trading side over in Asia, and along with another partner and I oversaw the currency and Japanese government bond and Japanese yen derivatives books. Now, we oversaw other people manage the books, and lastly, with another partner, I was in a financial role, a co-finance officer type of role. So I had a number of experiences that I draw upon, again, dated. But I think that is part of who I am. I'm proud of that background. I've learned from it, but I've also learned a tremendous amount in the 13 years since, working with President Clinton's economic team, working with Paul Sarbanes on what became Sarbanes-Oxley, and I'm learning every day on the job I'm in.
I mean, it's been also 13 years. Is it frustrating sometimes to still have that identifier?
No. I mean, my wonderful daughter Lee, one day calls me up and says, "Daddy, you're in Rolling Stone magazine." And I said, "Wow, I didn't know you read it." And she said, "Yeah, there's a picture there." I said, "How's the article?" She says, "Well, I don't think so favorable." You know, it's, I was very fortunate. I went to public schools. My folks were able to send, neither of my folks went to college, and they were able to send us kids, the 5 of us, to college, and I ended up on Wall Street at 21 years old. And it was a fabulous experience for me. And, but I also understand the concerns you raise, because the system failed, both in New York and Washington. It was not one or the other. Chicago actually did pretty well, by the way. Yeah. It did pretty well.
So does it help the reforms in some way because you are able to do the outreach in a certain way because you have that background?
You'd have to ask others. They could give you better feedback. But I think that I draw upon that experience. I draw upon the vocabulary. I draw upon thinking through the risk management. Learned a great deal about risk management when I was at the firm I was at. In the role over in Asia with a co-partner heading up a live trading business, and then the subsequent role in the finance function where we had to keep the books and records for, at the time, about 1,000 traders at the firm, far more now. So I think I benefited and learned a great deal. Again, a lot's changed. I just hope I can, keep learning and with my fellow commissioners move forward on rules that, again, promote transparent markets. I think that experience is part of why I believe that markets work best with transparency and competition. I don't think they work necessarily best when there's darkness. I have a lot of experience in 30 years, but certainly those 18 years, that I think markets work best for the investors and the companies who are seeking to invest and hedge when there's competition and openness.
Chairman, do you think that some of these clearinghouses will have to be designated as systemically important before they have to start to clear?
They already clear. The statute in Title VIII provides that the Financial Stability Oversight Council can designate some as what's called systemic, it's FMUs, financial market utilities. And the council has put out a list of questions, which is called an advance notice of proposed rulemaking, and asking questions and So there's a rulemaking process the council will go through, I suspect, this spring and summer. But at some point in time, those designations will come forth. But to answer your question, clearinghouses can clear, they already clear, interest rate swaps.
But not the amount of swaps that will eventually have to be cleared. I mean.
You know, actually under Title VII, Title VII of the statute has a whole clearing regime, and Congress was very specific. We've proposed rules based upon Title VII, and some clearinghouses are not systemically important and might choose to clear these. Some are very large and will clear. There's a clearinghouse that currently clears nearly $240 trillion of interest rate swaps. They've been registered with the CFTC since 2001. There's another clearinghouse that just started with a product in the interest rate market. There's 2 clearinghouses that are very active in energy swaps. Of course, there's a number that are competing in credit default swaps. So I think that clearing will move forward.
Regardless of whether they're designated?
Yeah, the designation adds certain additional authorities.
And protections about that.
Right, right.
And so I just wanted to follow up on, or I wanted to know what your plans would be once you leave the CFTC. I mean, I know you don't have to necessarily.
Have you heard something?
No, I haven't, but I assume you won't be CFTC chairman forever, so.
Well, we don't live forever. I lost my dear Francesca, that teaches me that. But I have no plans. It's a wonderful job. This is a great honor to be at the CFTC. It's a great honor because it's a great group of people, but it's also a great honor because of the times we live in. I mean, we had a tremendous crisis. Congress reacted, I think, appropriately in Dodd-Frank and particularly Title VII. We've got a great partnership with my fellow commissioners. We don't always agree, but just as in a marriage, we try to find a way to disagree agreeably. And a great partnership with Mary Shapiro. So it's a fabulous job, and we have a lot to do. The rule writing is going to go forward through this summer, and you know, we're human. I can't predict whether some will slip into the fall. And we have to reorganize the agency. We followed, I think it's on our website, a new strategic plan the last day with Congress and OMB. It's a 5-year strategic plan that calls for a reorganization and setting up some new groups for data and for swap oversight and so forth. So there's a lot to do, working with the commissioners, the staff, with the SEC, with Congress.
Can I ask you a little more about working with the SEC? I think it's fair to say that pre-Dodd-Frank it was a more siloed relationship, and you may or may not agree with that, but that's certainly the impression. You know,
I thought you might just say before January of 2009.
Well, you know, in the world of clearing, for instance, in securities, it's a kind of monopoly business, and you're talking about something else. I mean, given you're charged with working with them on a lot of these things, do you find the different perspectives kind of help, or make it harder to come up with something you think is going to be effective on some of these?
Some of both.
Right.
It's a wonderful relationship. And it's not just at Chairman Shapiro's and my level. It's our press office with their press office, our commissioners with their commissioners. When we do joint things, our commissioners are talking to theirs and vice versa. It's our clearing folks with their clearing folks, et cetera. It's a lot of collaboration, but there are differences. We have a statutory framework and a history in futures, and they have a statutory framework on securities. And let me just note one big difference. The futures market in the 1930s was mandated that it 100% be on exchange. There is a statutory mandate for transparent trading of these derivatives we call futures. And though the Securities and Exchange Act was strong, very strong, it doesn't have that similar background. You might even remember when I started on Wall Street, back to that question, there were many transactions on things called the pink, you know, these pieces of paper that went around, and the pink and the blue papers and everything. So there's different histories and different mandates. As we go about rule writing and the SEC goes about rule writing, we're going to be very consistent where we can be, but we're also both conscious about our current regulatory regime. Ours in futures, theirs in securities. Futures where 100% is on exchange, and securities where it's not necessarily 100% on exchange. So there will be some differences. We'll seek public comment, try to make sure the differences are as few as possible, and when there are differences, they're logical. But they're probably, at the end of the day, we have to be conscious of our two regimes.
Well, thank you very much, Chairman Gensler, for being madly signaled that your time has overrun. We really appreciate it. I think I'm allowed to ask you a final question.
Please.
Please.
Do you want to know about how Lady Gaga was on Thursday or tonight? Yeah, it was terrific. It was really terrific. And that's not in my statute book, but I can tell you it was really no, I didn't go with my daughter.
Oh my God! Really?
Well, that's not, I mean, that doesn't have to be
You
on.
went Bart, didn't you?
I'm not.
Okay, that doesn't count as our final question.
Okay.
So my final question is, you talked a lot about process, a lot about the great things that are going to happen in the future, and you've also talked about the really serious market failure, which was not that long ago. Right now, where we are today, are the markets you regulate safer than they were in September 2008?
I think that the futures marketplace they did perform well through the crisis, the futures marketplace. But we've, with the help of Congress, been able to bring our agency back to the resources we had in the late 90s. In 2008, we were at 440 or so people, nearly 25% smaller. In 2008, we were only spending $5 million on technology spend, and $112 million total. So right now, though we need more resources at 168 or 9 million, we're in a better shape.
But you've made a big
we're in
point to
much
us
better
that your
shape.
scope is also broader. So.
The swaps marketplace, to answer your question, we do not yet regulate the swaps marketplace. What we are doing with congressional mandate is writing implementing rules. So the public understands Congress passes a law and said you have 1 year with the SEC to write implementing rules. But we do not yet have the transparency, we do not have the competitiveness, we do not have the safety that comes from clearinghouses until the law goes effective this summer, and naturally that the rules are complete. In some cases, the law is self-executing. And I would also look forward to working with Congress on the resources, because we do need the technology and staffing resources. So I'm giving you a partial yes to the futures marketplace, but saying as it relates to the swaps marketplace, we're not there yet. It's a work in progress.
Just as dangerous as this before.
Well, there's a work in progress. Congress passed a historic law. The SEC and the CFTC are working thoughtfully, consider how to implement that. But the law itself is not effective until this summer. And I think it needs to be effective, and the agencies need resources to fulfill the mission. How we doing?
Thank
All
you
right.
very much.
Probably more on Lady Gaga, huh?
Well, it was a valiant effort to get you to speak as a human.